So, good morning, everyone. This is L2E Investors, and we are now today talking about future and options. See, this is a huge topic, so we will cover it in 2, 3 different sessions. So today we will mostly talk about future, and importantly, first point I want to mention that this future and option is a one topic. So you have to cover all the topics of the future, options, hedging strategies before entering into this segment of the market, right? The people say that this is very risky. Yeah, this is risky, but this is very rewarding also. So you have to understand everything. It should not be like without learning the swimming, just how to move your hand and you will jump into the water. Definitely you're going to, right? So this is one of the important thing that I wanted to discuss, that future and option together, they make it complete. First of all, I want to pay my tribute to Lata Mangeshkar ji. She passed today. And now, one good news also, we have won the World Championship, the World title, World Cup for the under 19 cricket team. And this is one of the good news that we wanted with the end of the pandemic, hopefully. And this will give us motivation also to move further. So, again, a quote from the cricket related to share market: patience is power and calmness is superpower. So if we'll keep patience in the market, you're going to win. Like keep patience and calmness in market, you're going to win. On the similar manner, you are going to win if you will keep patience and calmness, right? So what is future and options, right? Try to understand this first. A future is a contract to buy or sell. Like, let me mention it first again, that we are doing it like a series. So we have talked about the stock market, the basics of the stock market, technical analysis, fundamental analysis. So if you're the prerequisite of to understand this is you must be knowing about stocks at least. If you know about stocks, then only you will be able to understand uh, the future. Like there you buy one share, two share, 10 share, anything, right? But in the future and options, you buy a lot, right? I'm going to explain a lot. On the leverage, I'm going to tell you the leverage, and there is expiry. I'm going to tell you about the expiry also, right? So future contract, there you can buy also and you can sell also. In the stocks also you can buy and you can sell. But in case of stocks, if you have the stock in your demat, then only you can sell, otherwise you cannot sell. But say you are having the idea that one particular share will go down, you're very much sure about this, that this particular share is having some problem, the earnings are not good and that is going to fall, and you want to sell it, you know that the price will go down, but you're not having in your demat, then how you can sell? You cannot sell. But in case of this uh, stock future market, you can sell a contract and you can buy it later on a lesser price and you can make profit, right? This is how you can trade the market in both ways, right? And there is a specific date, and that is known as expiry. Option, the contract gives opportunity to investor to write, but not the obligation to buy or sell the asset. So we are going to discuss it next week, most probably. Options. So options are two different kind of options. Let me tell you briefly. Call and put options. Call is right to buy and put is right to sell. And there the margin money is again very less. If you are buying a contract, it means you are buying a put or you are buying a call, right? So call and put, let's do not get confused. We'll discuss it later. We are going to discuss the futures only. So say what is the use of this future? Say this is a farmer, and this farmer is a cotton farmer, and he grows cotton every year, and he sells it to that commercial crop, so he has to sell. He sells it to the textile industry, and textile industry every year they buy cotton, from the open market and they make cloth and they make profit out of it. So say this farmer is having certain cost of production of this particular cotton produce. Say he, for say 1 unit of cotton, see the production cost is say 200 rupees, and definitely he will not sell it in the less than 200 rupees, right? And for the textile industry, they need to buy it up to the price of 250 rupees per unit. Will buy it above 250 rupees per unit, then they are going to make loss. Right? It means definitely the raw material is cotton, and if say cotton prices will go high and their raw material cost will also go very high, and their produce, their cloth that they are making will not be that production will not be remain economically viable. If that will not remain economically viable, then there is no point of buying cotton at a higher price and selling cloth at a lower rate, right? So what will happen in that case? There is the problem with the farmer, because the price of the cotton also fluctuates on both sides. It goes down, it goes up. But that farmer thinks that if he will be able to sell somewhere around 240 rupees or the 250 rupees per unit, what's about the unit, they call it, there is a technical term for the cotton 1 unit. I'm not going to take it on discussion, that will make the discussion heavy. So say I'm going to tell it 1 unit only, so they are selling it at 200, he is willing to sell it at 250 rupees, say. And the textile industry is also willing to buy it at 250 rupees today. But today the cotton crop is uh, the farmer has sown the cotton, and that will become that will ripe, or the produce will come after 3 months, 4 months, 5 months, or the 6 months, right? And there the farmer needs assurance that he need to sell it at 250 rupees, right? And the price fluctuates. If the say what happened last year, there was no rainfall, or there is very high rainfall during the ripening of the cotton, the prices becomes very high. And for the farmer, if there is huge amount of production on a particular year, the prices will fall like anything, and he will not be able to get any profit. So what he will do? He will, because the fluctuations, see, you can see the fluctuations are there. One time the cotton price was 80 rupees, another time it was 100 rupees, another time it was 50 rupees, another time was again 80 rupees. So what happened? Instead of that, farmer decided that instead of uh, selling it on the price at the future after 5 months, let's sell it today. So he has made a contract, say he is going to produce say 100 units, and textile industry, they are willing to buy 100 units, and they agreed at a price of 250 rupees. So farmer is willing to sell after say 5 months. At the end of September, he want to sell this particular, at the end of August, say he want to sell it at the price of 250 rupees per unit, and the textile industry want to buy it at the rate of 250 rupees. So what will happen? Now farmer has got the assurance that he is going to get 250 rupees per unit at the end of the August, and the textile industry will also got assured that they are not going to get it at a higher cost. They are going to get it at 200 rupees, 50 rupees, 250 rupees per unit. So that is a win-win situation. It means farmer is also getting it on amicable price, and textile industry is also getting it at an amicable price. So what's about the price? What will happen, say, after say 5 or 6 months, the cotton prices will go on up, say 300 rupees per unit. Now farmer has to sell, because he has made the contract that he is going to sell at 250, and textile industry has to pay 250 rupees only. So in that case, textile industry will get benefit of the 50 rupees per unit according to that price of that particular month, and the farmer will lose 50 rupees actually, because he has taken the assurance to sell it at the 250 rupees per 250 rupees per unit. But what if the price has gone down to 200 rupees per unit? In that case also farmer will get 250 rupees, and textile industry has to pay 250 rupees. But that is one-to-one contract. That is one-to-one future contract, right? On a particular date. We made the contract today for a future date, but this date is decided today. What if the textile industry is not willing to accept that contract after 5 months? And what if the cotton prices have gone up and the cotton prices have become 300 rupees per unit or the 400 rupees per unit, and the farmer decided not to honor the contract? Then there should be some regulator. They have to go to court or somewhere, and they will show the contract, and whatsoever the decision will be there, they have to follow that. And instead of that, what happens in the future market in stocks? There is a future price, and one person buys, another person sells, and there is exchange, NSE or BSE, and there is SEBI who looks onto all this matter. And if you have bought that, you have to pay the price, and you have sold that, you have to deliver the shares. That is how the exchange play an important role, right? So this is the concept of the future, right? So now I'm coming to a definition. If you're not able to understand this particular definition, not a problem. A derivative is a contract between two or more parties whose value is based on a agreed upon underlying financial asset, like a security. Now, what is underlying financial asset? Say what happens in the stock market. There are a number of shares available. Like there in the previous example, there was cotton. Cotton price was the underlying asset, right? In a stock market, Reliance share is there, TCS share is there, or any other share is there. And what happens is, say there is a particular price in a market. Say TCS price is somewhere around 3,828 rupees today, or 3,800 rupees, say today, right? And you believe that there is buyback under TCS, and the buyback is a 4,500 rupees per share, and that too within 1.5 months. So it means definitely you think that the TCS price will go up, right? TCS price will go up, and by the end of next month, it will be somewhere around 4,100 rupees or the 4,200 rupees, right? And for this, you want to buy this share on a future date, on a future expiry date, just like cotton. Like you are a textile industry and you want to buy it today because you know that the prices in the future will rise. So what you are going to do? You are going to buy one lot of the TCS. What happens in the future market? You cannot buy a single share. You have to buy a lot. So there is a lot size. Say first of all, first thing you have to understand that every share is not available into the future contract. There is approximately 200 shares in the Indian stock market. Those are available with the future contracts. So you can buy in the future, you can sell in the future only 200 those shares only. You cannot sell every share, first thing. Second thing, you cannot buy one share or the two shares in the future. You have to buy a lot. And the lot size for every share is different. Like the one lot, the price of one lot is approximately, the exchange try to keep it around 5 lakh rupees. Right. So 5 lakh rupees for one lot. But interestingly, you need not to pay while buying, you need not to pay total 1 lakh rupees. Right. Generally, the contract rate is 10%, 20%, maximum 25% for a future contract. Like you are going to buy a particular share for say 5 lakh rupees, you need to pay only 1,25,000 approximately to buy the whole lot. All right. So what will happen? Say underlying price. First of all, try to understand the thing underlying. Let's say there is a cricketer. There is a cricketer, say Virat Kohli, and Virat Kohli has his one bat in his hand, and that price of that bat, ordinary bat, is 1,000 rupees. What if the Virat Kohli makes a original signature on that particular bat? Definitely the price will go high. And on the auction, the people are willing to buy that on a higher price because that particular bat is having the signature of whom? The Virat Kohli. So that is the asset. That is a particular asset, and there is an underlying value of that particular asset, and that will trade in the market. And that value of that particular bat will go accordingly, the performance and that reputation of the Virat Kohli. Say Virat Kohli is not performing well in the next 2-3 years. What will happen? What will happen? He will not be able to. He will not be able to create that value for that particular bat, right? So what will happen in the future? That value will not rise accordingly, or it may happen that the value of that particular bat may go down. So the underlying asset In this case is that particular bag which is having the signature of Virat Kohli, like a 100 rupees note carrying the signature of RBI governor. So that is what? That is the underlying value guaranteed by whom? The RBI governor. So that is the underlying value of particular thing. So Reliance future is having the underlying value of that Reliance stock. TCS future is having the underlying value of TCS stock. So the value is decided according to the cash market price of a particular stock. So in the cash market, if the stock goes down, generally that future prices also goes down. If the cash market price goes up, that the future price also goes up. So this particular kind of derivative not only trade with the stocks, but it also trade with the bonds, commodities, currencies, interest rate. In interest rate, that is known by the name swap, right? And you can also buy indexes also in the future, that is Nifty, Bank Nifty, different kind of indexes also trade in the market. You can buy as well as you can sell those indexes, right? So this is how it works, right? Now coming to say another example. Say we know the pandemic situation is going to end most probably, but we are not sure, right? And we know that the area where the students live, like one of the area where we live is Zias, right? And what happens here? There is houses or the rooms available, and we know that for the next 3 months the condition will improve and the rents will grow. And instead of that, what you have decided? You have decided that let's not go into all this thing. I know that the prices will go up and the rent will go up. And on normal days, a particular room, a particular house is uh, used to charge a rent of 20,000 rupees. But now that is easily available in 6,000 rupees rent today, right? Due to there's no one is willing to take that particular house, so that is available on a quite a cheaper rate, on a 1/3 price, right? 1/3 rent. And you know that after 3 months that will be approximately at least 15 to 20,000 rupees per month rent will be there. So you went to that old landlord and you told that I am willing to take this your house on a rent, and I'm willing to pay 10,000 rupees per month, but not now. I'm going to pay it. I'm going to take on rent from the month of say April, from a month of April, right? And you are willing to rent this out from the month of April. You can take this token money of say 5,000 rupees from me. Keep this, and I will come in month of April. I'll pay next 5,000 rupees, and per month 10,000 rupees I'm going to pay. He is not aware about the condition, or he do not think according to you that the condition will improve, and he is willing to rent it out, right? He knows that he is getting now 6,000 rupees per month, and in the future there is a contract between you and the landlord that you are going to pay 10,000 rupees per month. Now what will happen? Say the condition improves, the most likely condition will improve, and what will happen? The rent price will go up to 15,000 rupees per month, and you will enjoy a house on a discounted rate of the 10,000 rupees, and you can continue on that particular house. But what if there is another, God forbid, what if there is another variant comes and the prices will remain 6,000, or it may go to 4,000, still you have to pay 10,000 rupees per month for that particular house. This is how the future prices works. I hope that is clear to you how the future prices works, right? Now, the important point that we have learned, that there is a financial contract set between two or more parties, right? Once you sell, somebody buys, and when you buy, somebody sells. Then only the trade happens, right? So you have bought a future contract. It means somebody has sold that particular contract, right? And these derivative, the future market derivative, that can be bought and sold in the exchange or the over the counter. Sometimes that is over the counter also, right? I will tell you what is the over counter later on. The price of derivative derives from the fluctuations of the underlying asset. The underlying asset like Virat Kohli bet was the underlying asset, or in our case, Reliance TCS share, those shares are the underlying asset, right? Derivative are usually leveraged instrument. It means you can buy and sell it on a with a little amount of money. You need not to pay full money, right? That increases their risk and reward. How? I'm going to tell you. And the common derivative include futures, contract, forwards, option, and swaps that I have told you. Now, future. Coming to the specific future, right? So the generally what happens, this particular kind of future contract created for hedging. Hedging means like what the farmer did. Farmer has sold his cotton produce 6 months earlier and got the guarantee that he's going to get 250 rupees per unit, right? On the similar manner, a particular textile company has got it in the future at a 250 rupees on a fixed price. So this mitigate that particular risk, and that speculation or that particular ups and downs of the in the prices can be reduced, right? So this commitment of buying and selling according to the underlying asset is actually a future contract, right? Now coming to the real-time example. Real-time example, for example, say on 6th February 2022, today. Today is Sunday though, right? Company A buys a future contract of the oil. Oil means I'm talking about the crude oil prices. Today the crude oil prices say come around $92.22 per barrel, right? And that the contract belongs to March 19, 2022. Why the company do it? Because the company does this because it needs oil in the March, and its concern is that prices will rise before company needs to buy. Why, say Reliance, they are running a refinery and they want to buy oil in the month of March contract. Why they are buying it on a price of 92.22? Because they know that the prices may jump to $110 or $120 later on. They are willing to buy March contract at $92.22 now, right? Now buying this oil future contract hedges the company risk because seller is obligated to deliver oil in company A in $92.22 per barrel. So seller has to deliver it on this price only that they have bought it today. Once the contract expires, assume oil prices rises to $110 per barrel by March 19, 2022. Company A can accept delivery of an oil from the seller future contract, but if it no longer needs the oil, he can also sell contract before expiration and keep the profit. Say Reliance has, in the month of March, Reliance has got huge amount of oil already available with them. And in the month of March before expiry, they come to know the oil prices has gone up, say $110, $120. They can sell the contract to another party and they can book the profit. But what if opposite will happen? The company who has sold it at the $92.22 per barrel, right? And they have to deliver this particular oil on the 19th of March 2022. That's the expiry date for the crude contract. What will happen if the prices has gone down? The company who is selling the oil, they will still get $92.22 per barrel. They will still get because they have sold it on this particular price. So this fixes the price for the buyer and seller both. So it actually gives you the idea, gives you the profit once you will imagine the future prices after 10 days, after 15 days, after 15 minutes, after 5 minutes, after 5 months, whatsoever it is, right? So why to trade in derivative? First is risk mitigation. Risk mitigation means you know that this particular share will go down, right? And you're having that particular share and a huge amount on your portfolio. You can sell it on this higher price and you can buy the same contract on the lower price. By this way, you're going to mitigate the risk of the downside of the market. On the similar way, you can get the profit from the upside of the market. The contract flexibility is there. You can buy it for the different months. Different months means you can, now I'm going to tell you the future is available for the next 3 months. Next 3 months means today the future is available in the stock market for the month of February, for the month of March, and for the month of April. And the leverage speculation, it means on a small amount of money, you can make big profit. But beware, you can make big loss also, right? So expiry. This is the 3-month expiry is generally available, always available in the market. One is this month. This month is the month of February, and the last Thursday of the February will be the expiry for this month contract. The day this month expiry will expire, and the next day that another month expiry will start automatically. The next month, that is March month expiry, is also available today. You can buy for the March future also, and the far month, that is April month, you can also buy and you can also sell. So February you can also buy and sell. Next month, for March month, you can also buy and sell, and the far month you can also buy and sell. So 3 different months contracts are available in the stock market, right? This month, the last Thursday. For the March month, the last Thursday of the March, and for the April month, the last Thursday of the April will be the expiry date. Important thing: if the last Thursday is a holiday in the market, then Wednesday will become the expiry. That expiry will move 1 day ahead. It do not get postponed. It get ahead of by 1 day. So this is how stock market the expiry works, right? So you have bought a April contract. Say you bought a April contract, a particular access stock on 100 rupees, and after 10 days it started trading at 110 rupees, right? And you got a good profit of the 10 rupees per share, and the lot size is say 1000 share is the lot size. So you have got 10,000 rupees profit. I will tell you the calculation also. Now you can sell it before the expiry of the April any point of time. Say you have bought a contract, you can sell it before last Thursday of the April any point of time, and you have sold it, you can buy it before last Thursday of the April any point of time. During the market hour, it means you can buy it, you can sell it anytime in the next 3 months. If you have bought or you have created a contract in month of April. Say you have created a contract in month of March, you can buy it and you can sell it for the before the last Thursday of the month of March, right? So why to buy and sell in the month of February? Because most number of contracts, and you'll get the good price while buying in the month of February. You'll get the real price very close to the underlying price in the month of February. Once you start moving ahead, definitely some amount of the time value increases the price of our underlying asset. It means they start going to further. Start going further. Start going to the month after month. The price will increase. I'm going to show you the market also. So how to trade, right? Say lot size of this particular series, say TCS, Tata Consultancy Services, right? And the lot size, I have told you that in the future market, you cannot buy or you cannot sell one share or the two share according to your multiple. You have to buy in lots. So you can buy either 150 shares or you can sell 150 share lot size, right? So let's go to calculation. Say 150 shares are there and you are going to buy one lot. So real price according to the current price of the TCS, that should be 5,74,200 rupees, the real price. But that is available in the market. One lot of the TCS is available in the market in 1,21,762 rupees only. That is 1/5 of the 20% price you will pay, and you can buy 150 shares of a particular contract. Right. Now, what will happen? Say the price will move 1 rupees up. You have got a lot of 150 shares. So definitely that will give you 150 rupees. If price will move 10 rupees up, you'll get 1500 rupees. Say price will move, in the case of TCS, say price can easily move to 100, 200 rupees within a week. Then you can get 200 multiplied by 150 rupees in one contract. But in case the price starts going down, definitely you are going to lose the same amount of money, right? Now, try to understand the term leverage. Leverage involves purchasing security on margin. Borrowing money strengthens their buying power in the market. Margin can also be used to make short bets, make trades derivatives such as futures and swaps contracts. Say what is going on. See, say why to trade in the future market? You can buy 150 shares directly also from the cash market. But if you're going to buy 150 shares directly on the cash market, you need to pay complete full amount of money, that is 5,72,000 rupees. But say you are going to buy a future contract of the 150 shares, you need to pay only 1/5 of the amount. By the same amount, you can buy 5 times shares. So say 150 shares you have bought, right? And you have paid 5,72,000 rupees, and share price increases by say 10 rupees. Then you will get 1,500 rupees only. But with the same amount of money, you can buy 5 lots. 5 lot. By the same amount of money, you will buy 5 lots, and the same amount of price rise will be the future market also. So you'll be able to get 5 times of the money, that is 7,500 rupees. This is how you can increase your profit with the help of the leverage. Right? Let's check with the market. Now going to the market. Let's go to let's go to there, right? So this is TCS. Now you can see it there. In the TCS, there is February contract available, March contract available, and April contract available. February contract also available, March contract also available, April contract also available. And you can buy any of these. You can buy any of this. Once you click the buy, it will show you the quantity 150. You cannot change this quantity. Once you increase this quantity, it will become from 150 to 300. So it will be in the multiple of 150 only. So you cannot buy 1 share, you cannot buy 2 share, you can buy 150 shares only. In case of, so this is the lot size in case of TCS. Let's go to Idea Vodafone. You'll buy Vodafone future, right? Idea February future. Let's buy it. The 1 lot of the Vodafone is available with the 70,000 quantity. 70,000 quantity, and the price per lot is 11 rupees 25 paisa for the February future. For the February future. And you need to pay 4,03,255 rupees 13 paisa. The margin required is written there at the bottom. You see it carefully where my cursor is. It is 4,03,255 paisa. So what will happen if the Vodafone Idea future will become 12 rupees 25 paisa, say tomorrow you'll bought it on 11 rupees 25 paisa, and it will rise and it will become 12 rupees 25 paisa, you're going to get 70,000 rupees. But say price will become 10 rupees 25 paisa, then you are going to lose 70,000 rupees. So that is the matter of minutes, matter of seconds. When fraction of seconds price goes up and down, and your profit and loss will also go up and down. It looks very risky, it looks very rewarding, but you can control this risk with the help of hedging, right? You can hedge it with the options that we are going to tell you tomorrow, right? Now I'm going to show you another thing, right? Just see this. Let's take the example of Reliance Industries. And the Reliance Industries, this is the current price of the Reliance Industry, 2,331 rupees. Right. Now what is going on? Let's check the future price. Future price for the 24th, the expiry on the 24th February 2022. The last Thursday of the month is on 24th February 2022. And the price for the February month is little higher, 2,338 for the Reliance future. Let's go to March future. Change it to the March. In the March, the price again 10 rupees higher, 2,348 rupees. And what about April? In the April, that is again 10 rupees more higher, 2,358 rupees. So what is going on in the Reliance? Once we start moving from this month to next month and next month to far month, for every month price increases by 10 rupees, because you can assume this just like an interest rate. Generally, there is a time value with the future value associated with, right? Because if you'll buy a April month future, there are more chances that Reliance may go up from this particular price. So definitely, this become 2400 in the month of April. You are going to get 50 rupees per share. By the way, in case of Reliance, lot size is 250 shares. So we'll buy one lot of the 250 shares, and you can sell one lot of 250 shares. So say you have bought it at the 2,358 rupees today. It means tomorrow, once the market open, you've got on the same price or the lesser price, 2,358. And somewhere between tomorrow and the last day of the 28th April, last day, that is 28th April 2022, in between the price starts increasing and you have got a chance to sell it on 100 rupees higher. 100 rupees higher means 100 multiplied by 250 is your total profit. So 100 multiplied by 250, 25,000 rupees will be your profit. So this is how future market works. I hope I tried to clear most of the things, right? But it may happen that you need to understand again, right? So you may understand again with watching the same video on our YouTube link. Right. So YouTube link is by the name L2E Investors. I'm going to send it to you after 1 o'clock. I'm going to send you the link also. So this is how the future market works. I have told you few basic things, right? One thing is you have to buy in lots. You can buy on margin, right? And you can buy and you can sell also. The three different futures are available every time, right? And you can hedge it, but hedging I'm going to tell you on the next week. So these are the important points in the future market. But you are buying on the leverage, your prices may go up and may go down. So Dr. Roma Singh is me, and she is going to tell you few more things, few important things while trading in the future market, what you need to be
Thank you,
careful.
Priyansh. As Priyansh has told us that we can buy lots also in future market. So there are two things, why and how. Why means why we are doing futures. It seems difficult, but the thing is that we are in the market to earn money. And if suppose you are investing your time is also important. Then if you can understand futures, you can get more return in multiples if you are doing futures. So how you will be doing it? You will be doing by understanding both the things, understanding how we can buy and sell the futures, and besides this, how we can hedge it. Hedge means that we can make two positions in two different places. Means if we are buying, then we can sell another thing, so that if stock is coming down, then its value is coming down, future value is coming down, we can take the advantage of our other position. So we suggest you not to buy or sell futures now before understanding the full series, because it is very risky. But why we are taking risk? We are taking risk because in every business there are risks, but here we can control also. We have different methods to control, and first we should understand the controlling methods. Only then we should start any business. So here we want to tell you that it is very, very good thing that is available in the market. That is, we can buy in lots. Suppose you want to buy Reliance, you know that it is at 2338 level, and it was last month it was around 2700. So there are chances that it will again increase, and its increase depends entirely on the market Sensex increase. If it will be increasing, Reliance will be increasing. It is sure. So the thing is that if you have that much money with which you can buy stock, you will not get that much gain. That much you will get by buying the future. So it is good to buy futures. It is good to go with futures, but we have to understand that it is different than buying a stock. In the case of a stock, we can hold the stock if it is going down. We cannot hold future permanently. We can hold till its expiry. Suppose you are buying now the February future, you will have to come out from your position irrespective of the fact that it is above or below on the expiry date. So this is the biggest risk. This is the biggest thing which we should keep in mind, that because we are buying future up to a particular date, not beyond that. We cannot keep it beyond that. We will have to buy again if we want to retain our position. And in that case, we will be losing our money if future has gone down, if the price of the stock has gone down. So there are risks involved. There are things uh, which are there, which you will have to understand before going to market directly. And but this is a very good thing. This is better than buying simply stocks, because it is actually trading. In the case of stocks, you can go for investing, and in the case of future, you can go for trading. Trading means you are buying and selling, and we have also told you the technical details. You can check the technicals of a particular stock, and if you can earn with 50,000 within minutes in from market, but you can lose also. So it's better to first understand, first check, first the check technical details, and go for mock trades. You can check by doing some mock trades, means you check the future price, check the stocks whether it is going up or down, and after 5 or 10 minutes you check again. So you may come to know that yes, what I was thinking was okay or not okay. In this case, you will be managing your money in a better way. And now I'll tell Priyansh to continue. Thank you.
Okay, so this is how we can continue with the stock. Even if you want to carry a particular future position, another important information, you can roll out your position at the end of the expiry for the next month. But in that case, you have to pay the premium that we are going to explain it later on. And importantly, for the future contracts, those they buy future contracts, for them, dividends are not available. Dividends, whatsoever the stock provide dividends, that is not available in case of future traders. The dividend is available only for the people they buy and hold it on the cash. So this is a very big topic. We understand that, and we are going to continue this topic on the next Sunday also. From 12:15, we are going to deal with the same topic in Hindi. Before that, if anybody wants to ask any question, please ask. I know that this topic creates a lot of question in the mind, so please ask if you want to ask. You can unmute yourself and you can ask. In the next option trading, we are going to tell you about the options, put, call, and not only about these things, different strategies like straddle, strangle, iron curtain, number of strategies are there, and that keeps your risk minimum and try to maximize your profit. Okay, right. So I'm going to end this meeting now, and we will join at the 12:15 with the Hindi. Thank you. Thanks to all of you.